All right. Good evening, everybody. Thank you so much for joining us this evening for the first Endeavour exchange of 2022. We thought it would be a good idea, especially given everything that's going on out in the market, out in the economy, and in the news, to kind of do an economic update, essentially. And we're going to do some recapping of last year, talk about what happened. We're going to also talk about what we expect for the upcoming year as well. And so yeah, why don't we dive right into it now? Before we get into the actual numbers and the actual meat of this conversation, Brent, why don't we have a little bit of fun? Let's recap 2021, and let's talk about some of the highlights from last year before we get into all the market volatility and all that other stuff. But did you know that the top song in 2021? I bet you did know this because it's probably your favorite song, "Bad Habits" by Ed Sheeran. Did you know that?
I didn't know that, but I love Ed Sheeran. Bad Habits is not my favorite song. I'm into Shivers right now. So
Shivers. Okay. Here's another one. Top movie of 2021. What do you think?
You know what? I already knew this one going in just because we held an event with this movie, and box offices. There wasn't much playing this year. Big box office hit, so this one shouldn't be too much of a surprise. But Spider-Man: No Way Home, with grossing at this point $613 million. So
yeah, Spider-Man. You're right. It wasn't much of a competition because it was there was so much of so many movies were on hold and people couldn't go to the theaters because of the lockdowns and so on. But yeah, actually, Spider-Man: No Way Home is now I think it's up to $1.5 billion worldwide, so it's fourth all time now. But yeah, $613 million, as you pointed out, came in 2021. The top book was a book written by James Clear called Atomic Habits. Which is kind of interesting, as the book. I haven't read it. I don't know if you've read it, but I haven't read it. But it's as you pointed out to me, it's about establishing good habits, and so obviously people were thinking about that a lot in 2021 as they're either maybe coming off
or breaking bad habits.
Yeah, perhaps.
Yeah.
The person of the year, a lot of people would know this one just because it was big in the media, social media. Elon Musk, CEO and founder of Tesla, SpaceX. The Boring Company. Elon Musk is no stranger to most people out there, and so obviously it was a big year for him. He became the wealthiest person in the world a couple times. There was some bouncing back and forth, but I think his net worth reached something like $275 billion at some point. So anyway, person of the year is Elon Musk. Now, what's even more important than that, because, in Winnipeg, we are big on our restaurants. I think we still have the highest number of restaurants per capita in the country. What was your favorite place for takeout during the pandemic?
Not even close. And we're still getting takeout from this place, but it's Shabbatai on Portage Avenue. It's near U of W. It's excellent Thai. It looks like from the outside, it looks like a bit of a hole in the wall. And then you go in, it's super clean. Staff are friendly. The Thai is ideal. So their pineapple chicken curry, spice level 2, kept me coming back all year long. So
you're gonna be careful in the spice. I have some stories about being in Thailand with real Thai food, and not that this isn't real, but the spice level over there is insane. For me, actually, Thai food as well. Vientiane, over on, I think it's on Marion. Yeah, the wonton soup is unreal. I'm a sucker for some cashew chicken as well. So anyway, that's the fun part. Let's dive into it. So, we're talking about the pandemic. Brant, why don't you give us a bit of a recap of what we've seen economically during the pandemic and what we're expecting a little bit going forward here. So take it away.
Yeah, absolutely. Well, I think, doing a kind of market presentation, look back through the year and a look forward, it wouldn't make sense to start with anything but the pandemic. We've now been in this, over 2 years. We've seen so many changes along the way, and ultimately we're not out of it yet. We're not done with it yet, and so it's. I know everyone's kind of getting tired of talking about it, but when it comes to the economy and markets, it's really played one of the biggest roles in kind of how things have played out and possibly what to expect moving forward. If we look at 2021, we actually saw a significant drop in COVID cases early in the year, and we actually have a chart that we can pull up here. Well, we have a chart for each of our topics today, but we can pull it up here, and you can see that kind of that drop in those COVID cases, which ended up resulting in many economies opening back up, which ultimately drove the economic recovery that we were seeing through 2021 as kind of cases dropped. We were able, we know, just a couple months back, we were almost living as if COVID was no longer a thing. We had higher capacity limits at restaurants and gyms and all these different things. So that was really, we saw that in 2021, and now, at the beginning of 2022 here, we're in the midst of dealing with this Omicron variant, which we're seeing record number of kind of cases and hospitalizations now. Now, early data is suggesting that the Omicron variant is not nearly as deadly as previous variants, thank goodness. And so kind of moving forward from an economic standpoint, barring an emergence of a new, more aggressive variant, we actually should start, the belief is that we should start seeing these case levels and the fatalities peak. And a big part of that is just widespread immunity for people that have been vaccinated, as well as prior infections. And we can actually see on that one chart that we showed the approximate percentage of the population that they believe in the United States has immunity, and they're pegging it at around 90%. And when I looked prior just to see if there was any estimates here for Canada, they have it pegged in that 80 to 90% range as well. So, we've been in this a long time. Businesses are some have adapted quicker than others, but all are being forced to adapt because of how long we've been in it. And so, combined with this immunity and this adaptation from commerce, as the effects of the pandemic kind of continue to hopefully fade and end up more in the rearview mirror here, we should start seeing it play less of an impact moving forward, Grant. And so that's kind of our thoughts here, is that as we move through Omicron here, less and less, we'll be talking less and less about COVID and what it's done to the economy here for 2022 and beyond. I'll flip it to you now. Fiscal policy, we've seen a lot of stimulus, not only in Canada and the US, but across the globe. So maybe you could share with us some of what we saw from a fiscal policy standpoint in 2021 and what we might expect moving into 2022.
Yeah, for sure. And, it's interesting, as you were pointing out the cases, I was just thinking about how things have changed even this time around in this wave with Omicron, that it is more about living with the virus, it seems, in society than trying to completely lock down. And there's been talks and articles from experts in the field, not me, about going from a pandemic to becoming endemic, where we live with the virus in our society. And so I think we're starting to see some of that, and which is interesting. But yeah, to your point, like the fiscal stimulus that we've seen, and for everybody out there that might not be aware of kind of what fiscal policy means, it's really about the government spending and how much they're putting back into the economy, which is a little bit different like the monetary policy that we talk about, like printing funds and stuff like that. But this is more about how they're spending, what tax incentives they're giving, and things like that. So fiscal policy and the stimulus that, as Brent pointed out, we've seen a huge amount of stimulus put into the economy globally over the last couple of years even. And in the U.S. we're looking at to the tune of about $5.3 trillion added to their economy. And so it's a really interesting time because of that, but we're also expecting to see a lot less of that going forward. And as we're seeing, this week we've seen announcements from the U.S. Federal Reserve, and we've seen from the Bank of Canada as well, and the policies that have been put into place. they're starting to get weaned off basically, and we expect that we're going to see more of that throughout the year in 2022. Why less support? Well, frankly, the economy is expected to be healthier going forward, and so we're expecting that in 2022 as things continue to progress forward. And we have a chart here which essentially shows this, but we're expecting the economy will continue to improve. Now you can see that in the chart in 2020 that we had a very steep drop off in output. That's not a shocker to anybody on this call today, because we all felt it, we all saw it. So there was this big drop off. But 2021 was a lot more about the recovery versus the drawback, because that's what we were seeing. It was only held back really by a couple, well, more than a couple things, but a couple main things, held back by supply chain constraints, which we certainly again are all aware of, and also the labor market is still facing challenges. So supply chains and as supply chains and labor markets continue to settle down a little bit and things continue to get back online, the expectation is that economic growth will surge early on, but we do expect that it's going to slow down as well, and get back to kind of more of that regular 2% kind of per year. So again, we can see that in the chart that we've got, that we have seen a pretty big uptick, but as you can see in the chart, it is leveling off as well, and we can see it slowing down, but the expectation is that is going to continue on, but we are still moving in the right direction, which is back into recovery, and that's what we need to see. And from a fiscal stimulus perspective, that's what's expected out there right now. So, speaking of labor markets, though, Brant, maybe you can just shed some light on the labor markets and what we're seeing there.
Yeah, as you mentioned, this has been big challenge as we're moving through this recovery. The labor markets, have seen a good recovery, but there's still some issues there. And actually, the surge in GDP that we saw was mirrored by the labor markets, almost identical. And when we look back to December of 2020 in the U.S., the unemployment rate had ticked upwards to 6.7%, and now November 2021, we're down back in the U.S. anyways to 4.2%, and it's actually recently they just released some information, and it's lower. It's still not at its pre-pandemic level or low of 3.7%, but there has been a recovery there. Canada, the unemployment rate slightly higher right now at 5.9% as of December, but when we look at where Canada was sitting prior to the pandemic, we're only a little bit ways off from our pre-pandemic level of 5.7%. So again, some good recovery there. In the U.S., there was estimated at 22.4 million jobs that were lost, and they've recovered almost 83% of those now, so 18.4 million. In Canada, we lost nearly 3 million, and I believe we're only a couple hundred jobs shy of what we lost today. So again, some huge improvements. Although unemployment at 3.9 million jobs below the peak suggests that there's some labor slack that remains. When we look at wages, it's actually telling a different story, that employment might be fuller than the numbers are suggesting. And so we'll pull up this chart here, and we'll see this blue line, which shows the average hourly earnings. And what we're seeing here is we're seeing it rise, and it's rising to levels that we have, the markets and the economy hasn't actually seen since the 80s. And what that's telling us is that this employment shortfall that we're dealing with is likely due to less supply of workers or less people just willing to work. And why that's the case? Well, there's a couple main factors when we look at the market that would be holding that back. In a lot of parts of the world, we still see a lot of enhanced unemployment benefits that are out there. So less incentive to necessarily come back to work. Lower immigration levels. I know for Canada here, immigration is a huge part of how we build our labor force moving forward. And so with COVID, we saw immigration all over the world slow down, and so that's weighing on that labor supply. Costs of childcare. There's a lot of kids that are home from school or parents trying to go back to work, and if they're going to go back to work, they're going to need someone looking after their kids. So and if they can't pay for it, well, then they end up staying home or possibly not going back to the workforce, right? And so that's putting some pressure on that as well. And then obviously just lingering fears of COVID. There's a lot of people that are still, from a health perspective here, they view this as a huge threat to themselves or some loved ones in their lives, and so they're being extra cautious and just aren't putting themselves back into that workforce, especially in a lot of those jobs that are dealing with the public and out in the public. So now this is expected to what we're dealing with here is expected to persist for a little bit. But as we talked about earlier, as Omicron kind of fades into the rearview mirror, as we hope it will, there's a good chance that you actually see these the unemployment rates begin to improve even further, even though we've already had a pretty good recovery from the data that we're getting. So with that, Grant, I figure we'll then pivot now, talk a little bit about. We're talking about labor, but all those people are working for businesses, right? And these corporations. So when it comes to investing, we're owning these businesses, we're owning these corporations. So maybe worthwhile talking about kind of corporate earnings for 2021 and what we might expect moving into 2022 here.
Yeah, this is obviously where we get into like the investment side of it. I mean, it's great to talk economics, but this is the where the rubber hits the road, if you will, and as it relates to the portfolios. And we've been having a lot of conversations, especially with a few people about like things like corporate earnings, price to earnings, and things like that, and where things are at going forward. So earnings recovered. I mean, we saw like a spectacular recovery in earnings. Since the big declines that we saw early in 2020. I mean, businesses are doing extremely well in a lot of cases and hit new all-time highs in 2021. I say in a lot of cases, but this partly reflects like stellar performance in some of the most important sectors, and especially if we're considering like the U.S. Equity markets, such as areas like technology and healthcare and consumer staples. There was very few negative impacts from the pandemic in a lot of those areas. And so in many cases, we saw even stronger revenues throughout the pandemic. So it was kind of like, in some cases, a perfect storm for a lot of these businesses, but also, a rebound in the cyclical sectors that kind of kicked in 2021 as well. So, there was a lot of things to like in terms of corporate earnings in 2021. More generally, earnings have been, bolstered a lot by powerful consumer demand, higher productivity as businesses have been able to reduce costs in a more virtual environment. So there's been advantages from that perspective as well. So it was a really interesting time. And actually, we saw like a big recovery in the price to earnings, in the earnings. But if we can pull up the chart here, this is kind of interesting as well, because I know this is something that'll be of interest to a lot of investors. We can see that in our chart that, there was a 72% increase in earnings this year, driven, and then we can see that in the price to earnings ratio, driven largely by that better profitability. Now, this is, again, we're seeing things that were all-time highs basically in 2021. So that does partly reflect what we were seeing in those stellar earnings. But this also presents some challenges, obviously, going forward as well. I mean, given that these ratios are pretty high, and what is the challenge going forward, and can this be maintained? Now, some of this has been taken off the table in the last few weeks. I mean, as we've seen, like a lot of volatility and markets have corrected, fairly recently. Well, we're in the correction right now, and I'll touch on this later on. But what we're seeing right now is a fairly normal correction so far, anyway. From what we would see in a normal year, and actually like last year would be more of an abnormality where we didn't see a drawdown in the prices of stocks to the degree that we're seeing right now. So we're seeing a fairly healthy correction, let's put it that way, which is going to bring this a little bit back into whack. But all things in, I think 2022 is going to be a lot harder for these corporations to continue to achieve this high level of profitability, because there was a lot of like tailwinds that were pushing these things forward last year for a lot of businesses, and a lot of those tailwinds are no longer there. And so there's a few things that are going to make it a little bit more difficult. I mean, slower growth, as we were talking about earlier. We expect that the growth, especially in North America, is going to slow down. There are still lots of challenges out there, supply chain, labor markets, etc. So slower growth is gonna obviously be a challenge. Higher wages, as you were pointing out, Brent. I mean, it's the labor market's challenging, and so companies are having to pay more money to get more people in. So there's higher wages. That's a bigger drag on the corporate books because they got to pay more. Increasing interest rates. Debt's not going to be as cheap going forward. So there's increasing interest rates and repayments of things like that are going to cost more, and potentially higher taxes as well. There's a lot more headwinds that we're seeing going forward in 2022. And so that is going to be a challenge for corporate profitability. And it's not to say that things can't continue to look good businesses out there, that's for sure. But there are going to be some challenges that we just simply didn't see in the last year and a half. Some of the other challenges that we've talked a lot about is inflation, and I know that's top of mind for a lot of people, especially anybody checking out the numbers from recent weeks. So Brent, why don't I pass it over to you and let's chat on that.
Yeah, I was going to say, if you're not tired of talking about COVID, maybe you're tired of talking about inflation, because this has been another one where it seems like week after week after week after week, inflation. I mean, there's a reason for that. It has heated up significantly. You talked about this earlier. We've seen an increase in consumer demand, and then it's also collided with these supply chain issues. When we look at the latest kind of year-over-year gain, it rolled in at 6.8% overall, much higher than the 2% target. If we remove kind of food and energy, more volatile, portions of that number, it was around 4.9%. So still well higher than that kind of 2% target. And we can see in the chart. We'll pull up the inflation chart here, but this really is something that investors in the market hasn't seen. And a lot of investors won't have seen this since or in their lifetimes ever, because the last time it was like this was in the late 70s and early 80s. When it comes to kind of some of the areas being most affected, I'm sure a lot of us are aware of this one already, but the semiconductor shortage has really put some pressure on a number of areas. It's in semiconductors and computer processing chips are in everything that we touch now. And one of the biggest effects it's had, or the sectors that it's had the largest effect on, is actually automobiles being one of the most notable. So we're seeing less supply of new cars because they're having a hard time getting the chips they need to build those new cars. That input cost now, because there's less supply of them, the chips can go for more, so the cost of cars has to increase, but there's still not enough to go around, so there's not enough new cars. So now we're seeing prices, we're hearing stories of people having, selling their year-old or 2-year-old used car for like massive profits right now, because the used car market is going crazy. So these higher input costs, along with a recovery in certain items, if you think about like where airfare was a year ago, or rent, or some of the money that was being brought in by restaurants, if we look back a year ago, they weren't doing so well. But now, with a little bit of recovery and less concern over Omicron, we have this semiconductor as well as these other things that are finally rolling again, adding to this kind of inflationary environment. You talked about this earlier with the fiscal support that there has been for workers, and the cash that is in consumers' pockets. Well, the data has shown that the consumers are willing to spend it, and they're spending it. So a lot of these influences on inflation in the market, I would say we're in the camp that a lot of them are transitory or temporary. Particularly when we look at like energy and some of the semiconductor supply chain shortages. So those should work themselves out. Now it's tough to say when exactly that will be, when they will work themselves out. So we're not able to predict when that will happen, but they should should ease at some point. Now, on the headwind side of things, though, that you mentioned, and I talked about the labor earlier, but wage growth is putting some pressure, sending that inflation number upwards as well. Some rising rents. So the outlook for 2022 actually is that we will likely see inflation still run a little hotter than that 2% target for the remainder of the year. So that would be expected. I don't necessarily think it's cause for concern, but and what we've heard from a lot of the central banks, both Canada's and the US's, this is something that they're watching very, very closely, which is a great segue into our next segment here, Grant, where you're talking about Federal Reserve policy, or we'll call it monetary policy. Maybe you could just share with us a little bit on not only the U.S. Federal Reserve, but maybe comment as well on some of what we've heard from the Bank of Canada most recently.
Yeah, so this is a timely conversation, and because of what's been going on recently, especially this week, with meetings going on with the Federal Reserve and the Bank of Canada, making announcements that they're keeping interest rates the same for now. But I'll let you talk more specifically about interest rates in a second here. But it's obviously, since the pandemic began, we've seen, again, significant stimulus into the economy with, interest rates dropping to near 0%. And, in the U.S., they've added about $120 billion a month in bond purchases, or they added that, early on. Now, what we're seeing now is essentially the tapering off of those stimulus plans. So back in November, and I'm just speaking about the U.S., but we're seeing this here in Canada as well. But the November meeting, the Fed cut this by $5 billion a month. There's bond purchases in recognition of the progress that they've made in the employment sector and in the employment market, and higher levels of inflation as well. So they started cutting back, and then in December they accelerated that. So, with more employment improvements and more inflation, they became even more hawkish. So they accelerated reduction in the bond rates by about $30 billion per month. So they're picking up steam on those programs. And what that's signaling to everybody is essentially that they believe that the economy is getting stronger and stronger. And there's a few things that they need to keep in check on the other side of it, one of which being inflation is one of the things that they're closely watching. So they're starting to peel things off. And, what we've got a chart to show here as well. And I'll let you comment more specifically on interest rates. But, one of the things that has impacted, especially the markets more recently, is the prospect of rising interest rates. And so what we're showing in this chart here is that as a result of what we're seeing here, the market is essentially has priced in about 3 rate hikes in 2022, and ultimately another 3 in 2023 is what the expectation was as of not that long ago. Now, this is again for the U.S., but I think you can say the same for Canada here as well in terms of like what the expectation is on interest rates. Now, I would. Again, you should take this with a grain of salt, these predictions about interest rates, because, I've seen predictions out there that some people are calling for 6 rate hikes this year in Canada, and 6 and 7 even. And so, whether that actually comes to fruition or not, nobody knows. There's a lot that can happen in a year that's going to alter the Federal Reserve's interest rate policies or the Bank of Canada's interest rate policies. For certain. So I'm not. I wouldn't be in the camp of trying to make too many predictions and investment decisions necessarily based on a short-term factor. And like what you were talking about, Brandon, a lot of this stuff is really transitory as a whole, and so you need to be really careful in your investment decisions based on a shorter-term kind of outlook here. But that's essentially what we're showing. So and again, I think. Perfect time to talk about interest rates because that's top of mind for everybody. So, Brant, why don't you guide us through what your thoughts are there?
Yeah. So, you mentioned rates are increasing, and the central bank, both in the United States and Canada, they're telling you that it's coming. Canada has held off on a rate increase in the near term here, but again, they made everyone aware that it is coming. So to your point, we're not in the business of predicting how many rate hikes. it's just something that we need to be aware of. And so what do interest rate hikes mean for investors? Well, on the fixed income side of things, it's a challenge. As rates rise, fixed income is one of those areas where you'll see a decline in some of the value of those bonds. Inflation, faster growth, and less accommodated central banks are going to drive those interest rate increases. Now, this doesn't mean that fixed income shouldn't be a part of your investment portfolio. We absolutely still believe that it should be there to provide diversity and protection against equity markets, even if a lot of those fixed income investments were to pull back in value. They're not pulling back the same way an equity investment would, and so they can still be used really well as a kind of dry powder to tap into when certain businesses and equity positions go on sale. So now, what I will say is, with your fixed income and your bond holdings, shorter duration and high quality bonds should be a big focus, as they are the least affected by rising rates. And we'll pull up another chart here. Nominally speaking, rates have never been as low as they are today. And when we look at from an after inflation perspective, and we look at the returns on some of these fixed income securities, it's actually negative when you account for inflation at this point. And again, a lot of things going on that we haven't seen since the late 70s and early 80s, and that's one of them. So it's a tough. Rising rates is a tough environment, but what I would say is that it's also a signal that the economy is improving and we're getting in on better footing. Rates have been artificially low for a long time, and so I think it's encouraging to see them start moving towards I'll call it a more normal level, even though they're likely still to be low from a historical standpoint. And on the equity side of things, I saw some data today that the 3 months following a rate increase cycle, we typically, on average, and this is looking at 12 different cycles from the 19 rate hike cycles since the 1950s, but in the first 3 months after the cycle begins, there's an average drawdown of about 3.8%. But when we look at after that point on an annual basis, there's actually the S&P 500 anyways had an annual average return of around 9%. So it's not all doom and gloom, but it's definitely something that we need to be aware of here and managing for clients. Now, interest rates rising in the short term, it absolutely has an effect on corporate valuations and the value of the businesses that we own. So maybe, Grant, you could we'll pivot here and you could share more information on kind of our expectation on those corporate valuations moving forward.
Yeah, for sure. It is an interesting point you bring up on the this is a new environment for a lot of investors out there. I mean, there's a lot of investors, maybe even the majority of investors, probably the majority, have never seen a rising interest rate environment in their investing careers. And frankly, there's a lot of advisors I know that haven't seen it as well. And so it's an interesting time from that perspective. I do worry about. I mean, obviously we feel like we've been making prudent decisions and recommendations for our clients in this area, but I do worry about a lot of those people, especially in like the fixed incomes, like retirees that are reliant or traditionally be reliant on fixed income. As we get into more of this rising interest rate environment, where especially if they're relying on like lower interest earning investments like GICs and government bonds and things like that. And to your point, owning like in the bond space, high quality bonds with lower duration should prove valuable to those people. But getting to the corporate valuation side, it's certainly like a big part of the reason why we've seen these like the correction that we're in right now basically is due to the expectation of rising interest rates, and that certainly has an impact on short-term valuations, and that's why we're seeing these fluctuations in the market. But obviously we saw in 2021 corporate valuations moved higher in the U.S. in particular. Not for every company, but for the market overall, we did see things move higher. Stock prices continued to be elevated by historic as compared to historical standards. Granted, this has been coming down in recent weeks, but we can see this actually in a chart that we've got here that these valuations that we're seeing, have kind of come into line with what we saw basically during the .com era, back in the early 2000s, late 90s, early 2000s. And so, we haven't seen these price to earnings valuations ratios in that area since that time. Now, but this has been fueled by a lot of things, and I don't bring that up. I don't compare it to the .com era to like freak anybody out, because there's a lot of reasons for this, and so and there's certainly not a reason necessarily to think that that's going to like drop dead right now either. So there, with such low interest rates like we've seen, I mean, frankly, it's justified higher valuation metrics from a historical standard. I mean, there was basically free money out there. I mean, there's 0% interest rates. That money had to find places to go. If it wasn't going to go into traditional assets, like those fixed income assets I was referencing earlier, and if you leave it in cash, you're getting killed. I mean, you're getting killed on inflation. You're getting killed even on tax. So you're getting absolutely killed. So it has to go somewhere. And frankly, in a lot of cases, it's found its way into the stock market, because that's where it needed to go to generate a reasonable rate of return. So that's kind of where we were at. And low interest rates, like I said, fueled this. Fueled the prices. Now, earnings are likely to continue to grow, and in our opinion, in my opinion, we are likely to see earnings continue to grow this year. We mentioned some headwinds earlier on that companies are facing, but we still think that things are going to move forward. Rising interest rates will affect share prices in the short term. We've seen that. We've seen that certainly in the last month. But later in the year, we expect that profit margins will determine how companies perform. And so I think that what we're seeing right now is ultimately a short-term correction related to these events and these expectations on interest rates. But ultimately, the performance of the companies is going to determine the values at the end of the day, and the fundamentals behind those businesses is going to play out really as always. I mean, that's going to be the most important thing going forward. So I'd say outlook for the markets is positive. I mean, we feel positive on the market still, despite this recent activity. But you're certainly going to have to be choosy. You're going to have to be careful in what you're getting into and in what you're investing in. And I think that valuations are going to be extremely important to be aware of as you're buying into companies at this point. I mean, just ask any of the meme stock investors over the last year about valuations, what they were buying at. Because I mean, yeah, those valuations of some of those companies are still higher than what they were a year ago. But there's a lot of people that got absolutely slaughtered in those meme stock trades when they just threw caution to the wind and had no consideration for pricing that they were buying at. So I think you got to be really, really careful on pricing. But there's good reason to believe that good companies are going to continue to do well. So that's where we're at on the valuations. Speaking of valuations, though, and kind of continuing on, because we've seen the stories anyway, and we've seen some rotation, and there's been conversation around value companies, value stocks versus growth stocks. And so, Brent, why don't you take us through that and what our thoughts are on this?
Yeah, absolutely. We've seen years and years of strong performance from growth stocks, and what we're seeing right now in this rising rate environments is actually growth stocks are starting to slow, and we're seeing this rotation to more value-oriented names as we move through this recovery. We have another left chart here that shows when we look at value names right now, they remain historically cheap relative to growth, and they also come with a much higher level of sustainable dividends. So those are going to be names that are extremely appealing to investors, especially during this choppy time. Now, what we're seeing with this transition from kind of growth to value, this is not out of the norm. Generally, value tends to outperform growth during periods of above trend kind of economic activity and in a rising rate environment. So what we're seeing is definitely not out of the norm. I'd say our stance today is that you shouldn't have to choose between value and growth right now. I know our portfolio, there's some growth names in there. There's also some value names. There's a number of stable large cap names that would be considered growth companies that, as you had mentioned, Grant, we expect to continue to do well in this environment. And so, when we look at some of these, we'll use Apple as an example here. These rate increases. Apple's not sitting on a ton of debt. They have earnings now. They have cash flow now. The idea that these higher interest rates are going to make Apple that much less profitable, that's likely not the case. So there's a lot of large cap growth oriented names that are still worthwhile and maybe become really nice bargains here as we move through this volatility. On the value side, interest rates are rising. One of the areas that I'd say is going to benefit from that the most is the financial services sector. Your banks, your insurance companies, they all benefit and become more profitable in a rising rate environment. So you're going to see some opportunities in value there. And so, like I said, we don't think that you necessarily have to choose. You can have exposure to both. What I will say, there's one caveat, and Grant, you mentioned this in some of the meme stock names. I'd say over the last 2, 3, kind of 5 years, there's been a lot of people buying anything, e-commerce, tech-related companies that have been very far off from ever earning a dime. And so, I'd say you got to be very, very careful in this environment. And there's going to be some names that as rates rise, you may not see your investment back to being level for years to come, or it may never recover at all. So you still have to be very careful. But again, I don't think you don't have to choose between value and growth. So just to take it home here, Grant, on our kind of last topic for today's outlook, maybe you could just, we talked a lot about Canada, the U.S., maybe you could just share a little bit more as it relates to kind of the international space here.
Yeah, absolutely. So, as it relates to, and this is a really underserved investment category, we'll say, or geographic region. It's a broad geographic region when we talk outside of North America, but it's really underserved by a lot of investors out there. And obviously it's an area that we pay attention to in our portfolios, but anybody that's on the line that's not a client of ours might want to take a look at their exposure, because the global recovery has been delayed a little bit because of the Omicron, and that's we're still going through that wave globally here, but it's not derailed. Like, we are seeing improvements along the way, and I mean there's going to be progress this year with overseas, with vaccination programs gaining ground. I mean we tend to look at the world with this like lens of North America on it, and all you have to do is pay attention to the Olympics that are coming up pretty soon to see where vaccinations are globally and in a lot of other countries. We saw it in the Summer Olympics, especially. It should be improved by the Winter Olympics coming up in a week or so here. But that's all you need to see in terms of like where things are in terms of like vaccination programs around the world. I mean, we're very fortunate in North America, but that's continuing to progress along elsewhere. So valuations though are remaining extremely attractive in emerging and developed markets. We're seeing some of these compared to the U.S. markets, they're seeing some of the cheapest levels relative to the U.S. in the last 20 years. So we're seeing some just really great opportunities here, and and again, we've got a chart to show here. But international equities are offering a really much greater sensitivity to the global rebound. Like, we see, take an example, Japanese markets and European markets or economies, they're much more cyclical in terms of their growth. So over half of the equity markets in Japan and Europe are actually tied to cyclical trends, and so they're poised to actually benefit far more from the recovery than a lot of the names that would be a little bit closer to home. So I think additionally to that, we should see hopefully lower trade tensions. I mean, people forget we're still in a bit of a trade war here between the U.S. and China. Not a bit. I mean, it's a full-on still trade war going on out there. It hasn't been resolved. So lower trade tensions in time, lower dollar, especially U.S. dollar values in time, should increase and help international equities. So we're seeing a lot of promise, and especially East Asia and Europe, both are looking very promising. And I think this is one of those things where, again, I mentioned it's underserved, but investors would be really prudent to maintain like solid positions overseas, and that's pretty rare. I mean, we come across a lot of portfolios from other institutions that they're really lacking on exposure elsewhere. And I mean, you think about some of these opportunities from the fastest growing places in the world, and with fantastic businesses, they're just not in North America, and there's just incredible opportunities out there. And so I think that if you don't have a healthy weighting towards international positions, certainly now and then going forward, then you're going to be missing out on some of the best growth opportunities in the world. And you're going to be opening yourself up to more risk as well, just not only from missing those opportunities, but just frankly from a diversification perspective as well. So not the least of which is the pricing risk. We've been talking about that a lot. And I think you really need to, as I've said a few times, I think you got to be really careful on pricing. And so if you're not being careful on pricing, even if companies are earning more, you could still be getting into bad investment situations. And so you need to be very careful. So we're seeing lots of opportunities internationally, and I expect that we're going to continue to see that. You got to be a little bit patient sometimes with it, because again, we are still in a recovery phase here, and it's not going to be a straight up line. And I think that's where we'll close things off here, is just that outside of what we've already talked about, when we're thinking about what else to expect in 2022, we've seen a reasonable amount of volatility, obviously, in the first few weeks of the year here, and I think that it's certainly looking like that could be a theme for 2022 as a whole. I mean, we'll see. There's a long way to go. We're only a few weeks in, but there's obviously a lot of storylines playing out. I mean, the recovery from the pandemic, we expect to continue on, and frankly, I expect that in North America we will finally emerge from this thing. I don't know globally, but I think in North America we'll finally get a hold of this thing. But that doesn't mean that it's going to be smooth, like necessarily blue skies and smooth sailing just yet. There is going to be challenges with the recovery, rising interest rates, as you pointed out, Brand. Those are going to be challenges that need to be handled. Obviously, we've got political risks out there with what's going on between Russia and Ukraine right now, and things like that. And so now those are things that we're dealing with. I mean, there's always things to deal with, and so I think that it's not necessarily anything that we aren't accustomed to seeing, but it's just these are the stories of the day that are going on, and there is going to be some things to deal with. So I would expect, as an investor, we're going to see continued volatility, and I think you need to be prepared for that. But also keep in mind that this is fairly normal to see this type of fluctuations like we've seen in the last few weeks, in the last few months. This is more than normal than what we saw last year, where we didn't really have a drawdown in the markets to any great degree. And I think it's important to know that when we, on a typical year, we often get a drawdown in the markets of 10 to 15% quite easily, and so that happens on average almost every year. But 3 out of 4 years in the markets are positive years, and so there's a lot of cases that we get these drawdowns, but we also end up positive on the year in the markets. And so I don't think that anybody should be drawing any sort of conclusions based on the last few weeks about where things are going to go in 2022 necessarily. But I think you do need to be very mindful of where you're investing your money. High quality is extremely important in all asset classes, but especially in businesses that you're investing in, bonds that you're investing in, and I think that you need to be prepared to be flexible and be very aware of pricing. So anyway, that's where I'll leave it here. But certainly if you have any questions on anything, please feel free to reach out to us anytime. Certainly visit us at the website www.endeavourwealth.ca. Feel free to reach out to Brant or I anytime. We're always happy to answer questions, especially related to like portfolios and what the expectations are, and making sure that people are protected and also poised for growth in 2022. So feel free to reach out to us anytime. We're happy to chat. And I think with that, we'll close it off and let everybody go for the evening. Thanks very much, everybody.